Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Lear Corporation was founded in 1917 in Michigan as American Metal Products, supplying trim components to the auto industry. Over a century later, it employs nearly 186,000 people across 38 countries.
Lear operates two distinct businesses. The seating segment makes complete seat systems delivered just in time to automaker assembly lines. The E-Systems segment makes wiring harnesses, connectors, and power management for electric vehicles.
Seating generates roughly 76% of Lear's revenue. The segment delivers finished seats, foam, fabric, frames, and all components directly to auto plants, sequenced precisely to match each vehicle on the line.
The just-in-time model is strategically significant. Lear's logistics operations are deeply integrated with each customer's assembly schedule. Replacing that supplier mid-production cycle is genuinely difficult and costly for an automaker.
In the global seating market, Lear competes primarily against Adient. The two firms together account for a large share of outsourced automotive seating globally, effectively a near duopoly in a capital-intensive market.
The E-Systems segment is the more compelling growth story. Electric vehicles require approximately 3 times the electrical content of traditional combustion vehicles. More wiring, heavier power management systems, and higher-spec connectors.
Lear formally established E-Systems as a strategic segment in 2019 to sharpen its focus on electrification. The segment supplies wiring harnesses and electrical architecture for EV platforms at Ford, GM, BMW, and Stellantis.
Lear went through bankruptcy in 2009, one of the fastest restructurings in auto supplier history, emerging from Chapter 11 in under 40 days with a cleaner balance sheet and lower cost structure.
That lean restructuring positioned Lear well for the subsequent decade of vehicle production growth. The company rebuilt its dividend, ultimately growing it for 14 consecutive years to approximately $3.16 annually.
On margins, Lear operates at roughly 4% operating margin, compressed compared to historical levels due to EV transition costs, customer production disruptions, and input price pressures affecting the broader auto supply sector.
CEO Ray Scott has led Lear since 2018, having risen from seating operations through senior leadership roles entirely within the company. His institutional knowledge of the seating business is deep and operationally focused.
Lear's manufacturing network spans 257 facilities across 38 countries. Proximity to OEM assembly plants is a non-negotiable requirement for a just-in-time supplier at Lear's scale.
Peers include Adient in seating and Aptiv in electrical systems. Among all auto suppliers, Lear is uniquely positioned across both the seat system and electrical wiring categories, two distinct and growing content areas.
The core thesis rests on two structural forces: the entrenched seating franchise with deep switching costs, and the EV content multiplier in E-Systems that grows as electric vehicle platforms displace traditional combustion models.
That's the company chapter for Lear Corporation. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go. Lear Corporation beat Q1 estimates in a challenging auto environment. Adjusted EPS of $3.87 versus estimates of $3.51, a 10.3% beat. Revenue of $5.82 billion came in essentially in line. Lear makes automotive seating and high-voltage electrical systems, two segments with different growth profiles and the same OEM customer base. The stock is near its 52-week high. This is Charged Alpha. Let's break it down.
Lear Corporation is an automotive supplier focused on two segments: seating, the world's second-largest automotive seating manufacturer, and E-Systems, which produces electrical distribution systems, high-voltage connectors, and power management electronics for EVs and conventional vehicles. Market cap $6.7 billion. Major customers include GM, approximately 30% of revenue, Ford, Stellantis, and BMW. Seating generates the most revenue and is consistently profitable even in soft production environments. E-Systems is the growth segment, riding the EV content per vehicle increase. EVs require roughly twice the electrical content of ICE vehicles, and Lear is a qualified supplier to the most important electrification programs globally.
Adjusted EPS of 387 is the key headline. The GAAP figure from the income statement is 338 for the quarter. The difference reflects restructuring adjustments and one-time items that the adjusted figure excludes. Wall Street consensus tracks the adjusted number, and on that basis, Lear delivered a clean 10.3% beat. For context, Q4 2025 adjusted EPS was 161, a weak quarter driven by production cuts at GM and Ford. Q3 was 203, Q2 was 307. The Q1 2026 figure of 387 represents the strongest adjusted quarter since Q2 2025.
Revenue of $5.82 billion was in line with the $5.838 billion estimate, essentially a rounding difference. The prior year comparison, Q1 2025 revenue was approximately $5.8 billion, flat year over year. Flat revenue in auto supply is not a bearish signal. It reflects production volume stability rather than decline. Lear's top line is directly correlated to OEM production at GM, Ford, Stellantis, and BMW, a combination that held relatively stable in Q1.
Margins are tight but structurally consistent with the business model. Net margin on a trailing basis is 2.2%. Gross margin is 5%. Operating margin is 2.8%. These are auto supplier margins inherently thin due to OEM pricing pressure and the capital intensity of running global seating and wiring harness manufacturing operations. The question is not whether Lear can expand margins dramatically. It cannot. But whether it can sustain these margins through tariff uncertainty and EV transition.
Cash flow and balance sheet. Q1 operating cash flow was $98 million. Free cash flow was negative $26 million. CapEx heavy as Lear invests in new EV platform tooling. On an annual basis, free cash flow runs positive as tooling investment normalizes. Cash stands at $882 million. Total debt is $2.7 billion. Equity is $3.2 billion. The balance sheet is manageable, though free cash flow negativity in Q1 raises the ongoing CapEx intensity question. Management guided to improved free cash flow in the back half of 2026 as EV platform launches normalize.
E-Systems is the earnings growth vector to watch, as Lear launches programs on GM's Ultium and Ford's Blue Oval EV architectures. High voltage content per vehicle is materially above ICE equivalents, a per-unit revenue step-up the Street has been slow to fully credit in forward estimates. Lear trades at approximately 5 times forward 2026 earnings, the cheapest multiple in the auto supplier peer group. At 132.41, on a 52-week range of 82.88 to 142.84, the stock is near its annual high. 5 times forward earnings for an auto supplier with consistent profitability and growing EV content is the auto sector's valuation discount at work. The entire sector trades at depressed multiples because investors price in cyclical and tariff risk.
Peer comparison in the auto supplier space. Magna trades at 9 times forward, Borg-Warner at 7 times, Aptiv at 8 times. Lear at 5 times is the cheapest of the major named suppliers. That discount reflects 2 factors. GM customer concentration at 30%. Any GM production cut hits Lear disproportionately, and the perception that E-Systems is slower to ramp EV revenue than pure-play electrical competitors like Aptiv.
At 5 times forward earnings with a stock near its 52-week high, the market is telling you the recovery is already priced. The bull case for further upside requires either multiple expansion, from 5 times towards 7 to 8 times, or EPS growth above current consensus. E-Systems' EV revenue growth is the earnings catalyst that could expand the multiple. Evidence of sustained EV platform launches generating above-average margins would reframe the narrative from value trap to value recovery.
3 reasons to be bullish on Lear. First, E-Systems' EV content growth. Every major automaker is electrifying their lineup. Lear is a qualified supplier for high-voltage wiring and power management on multiple EV platforms. As EV production volumes ramp, E-Systems' revenue per vehicle grows, a structural tailwind independent of total vehicle production volume. Second, seating segment resilience. Even in soft production environments, automakers require seating. It is not a discretionary component. Seating generates consistent margins that anchor earnings through cycles. Third, 5 times forward earnings is pricing in no improvement. Any sustained margin recovery above the current baseline produces outsized EPS and multiple expansions simultaneously.
3 reasons for caution. First, GM concentration. Approximately 30% of Lear revenue comes from General Motors. If GM cuts North American production, which it has historically done in response to demand softness or tariff-driven cost pressures, Lear's top line declines proportionally and margins compress on fixed cost deleverage. Second, free cash flow negativity. Negative FCF in Q1 reflects CapEx intensity for EV platform tooling. If EV launch timelines slip at major OEMs, which has been a recurring pattern, Lear carries the tooling investment without the revenue return, compressing FCF for an extended period. Third, the flat to negative auto production backdrop. Global vehicle production is not growing in 2026. Lear's top line will not grow unless either EV content increases enough to offset flat unit volumes or Lear takes market share.
The auto supplier peer group all trades at depressed multiples: Magna at 9 times, BorgWarner at 7 times, Aptiv at 8 times, Adient at 7 times. Lear at 5 times is the deepest discount, pricing in GM concentration risk and EV ramp uncertainty. Versus Magna, Lear is more concentrated but more focused. The seating and E-Systems combination is cleaner than Magna's sprawling product portfolio. Versus Aptiv, Lear has more seating revenue, less exciting to EV growth investors, but is cheaper on every valuation metric.
Adient is the closest seating-only peer and trades at 7 times, a premium to Lear's 5 times. The Adient premium reflects its purely seating-focused model, which some investors view as cleaner than Lear's combined seating and electrical portfolio. The counter-argument is that E-Systems gives Lear a growth option that Adient lacks. And the E-Systems EV content thesis is what could close the valuation gap if Lear's EV platform launches in 2026 and 2027 execute on schedule. Lear's dual-segment model creates the lowest auto supplier valuation in the group and the most upside if EV content growth is recognized. Options activity on LEA was modestly bullish ahead of Q1. The put-call ratio ran approximately 0.75 as traders positioned for an EPS beat driven by seating segment resilience. Implied volatility was elevated at the 75th percentile for the auto sector, standard pre-earnings positioning in a tariff-uncertain environment. Post-earnings, the stock remained near its 52-week high and implied volatility compressed. Short interest is approximately 5% of float, not extreme, reflecting balanced market opinion on the tariff and GM concentration risk.
Insider activity at Lear has been constructive. Following the Q4 2025 softness, management filed insider purchases that aligned with the recovery thesis. The stock near its 52-week high suggests the market has largely credited the Q1 recovery. Institutional holders include Vanguard, BlackRock, and value-oriented active funds that hold auto supplier names as cyclical value positions. The institutional stability at elevated prices suggests the largest holders are not using the strength to exit.
Bottom line on Lear Corporation: a steady auto supplier delivering a 10% adjusted EPS beat in a difficult production environment. Seating anchors the business. E-Systems provides the EV growth option. At 5 times forward earnings near a 52-week high, the recovery is partly priced. The next catalyst is E-Systems revenue acceleration as EV platforms launch and generate higher content per vehicle revenue. GM concentration and free cash flow negativity are the ongoing watch points.
Charged Alpha is produced for entertainment and education only. Nothing here is financial advice, and we are not licensed financial advisors. Always consult a qualified professional before making any investment decisions. Past performance does not guarantee future results. The hosts and production team may hold positions in securities mentioned. Trade carefully.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.